Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Look for the bare necessities, the simple bare necessities. Forget about your cash and your net worth.
That was so weird.
Hey, Charlie Jewett here from the Renovating Retirement Movement. Coming at you while my dog barks. That's awesome. Say hi, Tiger. I don't know if you're picking that up, but that's pretty awesome. We did have a guinea pig escape last night. So it's possible that my dog found my guinea pig and in dog language is communicating, "Hey, Dad, I found your guinea pig. Come out here and get him before he escapes again." But to my human ears, it sounds like, "Woof!" So I'm not really sure what's going on. Come on now. It's episode 129. We're going to talk about the bare necessities. And where are my retirement peeps at? As if you could respond. Nope, it's a podcast, Charlie. No one's going to get back to you. I can't hear you. You can only hear me. It's one-way communication, but two-way love, because you people are the best. What am I talking about here? The bare necessities. I was interested because we officially entered a bear market or whatever it is. It's called the bears because bears, I guess, scratch down at you, and it's called a bull market because bulls go low and reach up as they, tear you apart with their horn or whatever it is. I'm not even sure where these names came from, but bull markets when the market's going up, more than 20%. Bear markets when it's going down, more than 20%. And that's kind of the first point I want to talk about is what is a bear market? Are they helpful? Are they bad? What do you do about them? Let's just get into the nitty-gritty. Does that sound good? So what are they? Let me just read a definition. Now, I went to the internet and put in, on purpose, bear market and bull market averages, because if you look at my Instagram page, which is Charlie's Pictures, so CHARLIES, pictures with a Z, with an S, charliespictures.com. I'll show you my Instagram page. You can see my pictures. I put there, a report somebody did on how long the bear markets last, how long bull markets last, how much it goes up during a bull market, how much it goes down during a bear market. But that was from 2013. We're in 2019 here. I want to see if there's any more up-to-date research. So I went to Google, my friend, and put bear market and bull market averages. And I didn't find the exact thing, same company that put out the first one. But I did find something pretty awesome. And it was under Invesco. And it said PDF to the left of it. I don't know if yours will do the same thing. But, it's like Invesco, static, U.S., content detail. I don't know what it is. It's this thing, U.S. bull and bear markets since 1956. So maybe that's something better to search. U.S. bull and bear markets since 1956. But I was looking for this chart. So I pull up the chart. And one of the important things to find out is, what is a bull market? What is a bear market? Well, we're talking about bear markets, the bare necessities, right? We're talking about that. So a bear market, here's their definition. A prolonged market period in which an investment has prices that fall, typically characterized by a stock market that has fallen at least 20% from its previous high. Now, let me just go to Google and say, are we in a bear market? Are we in a bear market? It's the first thing that comes up, CNBC. We are now in a bear market. Here's what that means. Man, this is teppanyaki, man. I'm cooking in front of you. I didn't even do this before I started recording. Let's see what they say. A bear market is when stocks see a 20% decline or more from a recent high, but they're also marked by overall pessimism on Wall Street. All right, that's awesome. What else? It's helpful to know what a bear market is because basically everybody's saying the same thing. The S&P 500 hit that milestone on Monday. This says, I don't know what Monday it would be. This is on December 24th, so the Monday before that. So sometime in December, the S&P 500 hit a milestone, dropping 20% from its 52-week high. So number one thing I want to just let you know is the definition of a bear market is when the market is down 20% from a recent high. Now, how often do we have these, so-called, bear markets? Well, that same graph that I found, right, from Invesco that shows it's a cool graph. I mean, it's basically the same thing as I have on my Instagram, but it goes through 2017 still instead of 2013. When you look at that, how often do we have a bear market? This one doesn't tell me, so I'm going to go somewhere else. I remember this now. I did a search for bear market and bull market averages. Same thing, so it's the same search basically. And in this case, I pulled up the one that says U.S. stock bear markets and their subsequent recoveries. This is from thebalance.com. U.S. stock bear markets and their recoveries, subsequent recoveries. And I scrolled down and has some pretty interesting data. It says, here's the split between up and down. And, there's a whole bunch of them. There's how many days, how many months, how many quarters. I don't know. Let's just look at years. 72% of the years are up. What are they measuring from? 1934 to 2014, this particular one. So 80 years. In 80 years, 72% of them were up and 28% of them were down. Actually, if you look at the 10-year rolling time periods, 88% up and 12% down. A lot of people will say things like, the stock market's been up over every 10-year period, and that's why you should use it, and blah-de-blah-de-blah. Why don't you invest while I charge you a fee so I can play golf? But that does not mean it's going to do the same thing in the future, which is why, the 128 podcasts before this, I'm teaching you how the stock market is actually an unnecessary tool. And what are the options? I'm not saying don't use the stock market, right? I don't have any money in the stock market because my safe investments do better than the stock market, so risk is not worth the reward. But I know how addicted people are to it, and some people just like the excitement. They don't want to make more money. They want to have more excitement. So you can be in the stock market, and I do, by the way, for my clients that have money trapped in 401ks that has to be in the market because you don't have any other options, then of course, if I'm managing that company's 401k program or plan, of course we're going to be in the stock market because there are not a lot of other options. But the key is here, we just want to know how often is it up, how often is it down. It's about, like 75% to 25%. 72% up, 28% down. It's about, every three out of every 4 years it's up and 1 year it's down. So that's how often we have these bear markets. And I am going to get into some super interesting stuff. I'm sorry to start with these boring statistics, but I don't know. I'm kind of analytical and I like numbers. So for some reason it excites me when I bore you. I don't know why. So how much do we lose? This is going to get into, important stuff that you need to know about. Who cares how often they come, blah, blah, blah. What do you lose? How small does your account get? How much money do you lose? What's it cost you to leave your money in the market during one of these bear markets? I don't know if that's what bears sound like, but in my dreams they do. So this Invesco graph I'm looking at, and you can look at the one on my charliespictures.com if you want to. It's very similar. It's got a little bit different numbers because this one's updated. It says the average loss in a bear market is 33.34%. Now, guys, that's about as close to a third as you could get. Might as well be 33.3333333, right? 33.34. All you have to do is look at your account statement or picture how much money you have at risk in the market. Okay, I got $1 million in the market. I have $100,000 in the market. I've got $300,000 in the market. Whatever it is, let's say $300,000. I have $300,000 in the market, either inside my 401k or an IRA or some sort of non-qualified account or a variable annuity or variable life insurance, yada yada, whatever it is. You're in mutual funds, stocks, bonds, and mutual funds. If we have a bear market right now and the market goes down, you can expect to lose about a third. I'm not telling you what to do. I'm not giving you advice. I'm not saying that's exactly what's going to happen. I'm saying as you plan for the worst, prepare for the worst, hope for the best, plan for the worst. As you hope for the best and plan for the worst, the way to plan for the worst is to say, if the average loss in a bear market is a third of my money, at the age I'm at, do I want to lose a third of my money right now? And traditionally speaking, the way that this was viewed in the past was, you know what? If you're close to retirement, that's probably not safe. But if you're in your 30s, 20s, 40s, whatever, if you're in your 50s and you plan to work till you're 70, you can afford to lose that 30% and keep investing, and you'll recover. And they were right, by the way, until the year 2000. They were right. And I'm going to give you some details, some research here that shows why bear markets are awesome. Like really, really important. They're necessary. The bear market necessities, the simple bear market necessities. They do awesome things for someone who was living from, the 60s to the year 2000. The problem we're having right now is that our market hasn't been delivering what it used to. If you heard me on the recent podcasts, the numbers are in now for 2018. So when you look at compound annual growth rate, the real measurement, not this baloney average rate of return that all the joker brokers use and is on your statement, is on all the TV shows and on all the computer software. If you look at actual compound annual growth rate, here's where I started, here's where I finished. That's as if I made blank per year every year. The S&P 500, depending on how you measure it, is only up 3 to 5%, less than 5, like even if you include dividends. So before fees, if you have a money manager, you're probably, at 3 or 4% for an 18-year period. More risk doesn't equal more reward anymore. But in the past, it did. So if you were younger, you just you just lose money, keep investing, keep putting money in out of your paycheck. You're buying things when they're cheap, dollar cost averaging, blah, 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 blah. When the market goes back up, you make it all back, plus more. And that's kind of been the traditional thing. But if you were close to retirement, you guys know there's a close family member of mine who retired in the year 2000, lost so much money, they had to go back to work. So the 2001 crash, they lost so much money, they had to go back to work and worked another 13 years. That's a giant price to pay. How much do you lose in a bear market? Is it 33% or is it 13 years of your retirement? I don't know. Depends on how you want to measure it. Or maybe you can say, how many years did it take me to save all this money? So if you're close to retirement, say, how many years did it take me to accumulate this money, this much money? You look at how long you worked. Say, okay, I worked 30 years. One bear market, which by the way often happens in a 12-month period, it just drops right away. Bear markets, the average length of a bear market is 12.2 months, about a year long. So in 1 year, you lose 33% of your money. And you go, how long did it take me to save this? 30 years. So in 1 year, you lose a third of your money, or 10 working years. You lose 10 years of effort. It took you 10 years to save that third of your money, and you lose it in 1 year. If you do that, the year before you retire, the year of your retirement, the year after you retire, God forbid you retire and don't listen to me and leave all of your money in the market and cross your fingers and hope. Hope is not a financial plan. You lose 10 years of your effort the year after you retire, you're in significant trouble, especially if you're taking an income out of this account, which I've done several podcasts on that. Reverse dollar cost averaging, when your account is going up and down as you're taking out a fixed amount of money, even when it's down, the chances of you draining that account before you die are very, very high. We don't want that, baby. That sounds negative. It is negative. So, the average length of a bear market, about 12 months. The average loss is about a third, 33.34 to be super exact if you're into numbers like I am. I like numbers. I'm a geek. So, here's something really interesting to me, right? I'm not, I have a Series 65 license. I manage money. I manage 401k plans. I go to all the trainings. I listen to all the hoopla. I'm the financial services whistleblower, so been challenging people to debates for 2.5 years, and they won't debate me, but I go read their stuff. I know what all the money managers say. I know all their pitches. I know all the whole asset allocation thing and and dollar cost averaging and this and everything always goes up, and you're going to win because I'll be on the golf course voting for you. I know all that. I usually don't like anything they write. I just think it's baloney. I think it's hogwash. But I found something. Can you believe this? Can you believe I'm about to say this? I had to pinch myself. Is this real? I found something about the market that I like. Somebody wrote something that I actually like. And it was in my doing research on bear markets and are they good, bad, or what are they for? And I found something on how they're necessary and how they're actually really good. And I want to read this to you. I want you to maybe go find this yourself. I don't even know this person. There could be somebody that does something I don't know anything about them. It's called 3 Benefits of a Bear Market. And I found it on MarketWatch. Yeah, marketwatch.com. 3 Benefits of a Bear Market from John Lim. L as in Larry, I M as in Mary. Really, really interesting to me. Okay? Here's what I want you to hear. I've never heard this before. The guy said, imagine you could choose from among 3 possible stock market, and he put SPX minus 0.42%. I don't even know why. But he said, imagine you could choose among 3 possible stock market scenarios. In scenario number 1, the stock market climbs steadily in a straight line for 30 years. Now, you got a picture in these 3 scenarios. He's talking about somebody saving for retirement. So every single month, someone's putting in whatever, $300 a month, $500 a month, 5% of their paycheck, whatever it is. They're buying the stock market by investing through a 401k or whatever it is. And here's the scenarios. Scenario number 1, it climbs steadily in a straight line for 30 years. Now, doesn't that sound like the best possible scenario? You start investing in the market and it goes up forever. That's the hope, right? Sounds awesome. This really surprised me. Scenario number 2, you're hit with periodic bear markets over the 3 decades. Well, that's kind of the way it actually plays out. You know what I mean? You have 78% of the time the market's up, 72% of the time the market's up, 28% of the time the market's down. So you have periodic bear markets. That makes sense to me. That's what we've actually seen. So scenario number 1 sounds like it would be the best. Scenario number 2 is kind of what we've already had. Scenario number 3, this is the one that really shocked me. Stocks go nowhere for years. Man, you're investing for 10, 20 years, and there's just like no growth. I mean, it's just your own money in there. All you see is contributions. Nothing. Before powerfully rallying toward the end of the 30-year period. So, you understand the scenario? Scenario number 1 goes up forever. Scenario number 2, kind of up and down with periodic losses and bear markets. Scenario number 3, super hard to live through, goes almost nowhere until the very end of 30 years. You've been investing and seeing no growth for a very long time. And then it powerfully rallies. It just takes off like crazy towards the end of the 30-year period. In all 3 scenarios, the market averages, they end up at about the same level. This is why I don't use averages, because average rate of return is a lie. The market knows it. They may all be averaging 8%, but you end up with different amounts of money. And it's important. The size of your account matters. That's your nest egg. So they end up with the same, average rate of return or whatever it is. The only difference is the path they took to get there. Assuming you're in the workforce the entire time, I'm still reading from the article, and saving and investing consistently, which stock market would you choose to live through? If you picked scenario number 3, congratulations. And this is what shocked me. I wouldn't have thought this, but it makes sense to me now. That's the best market scenario if you want the greatest wealth at the end of the 30 years, which is the whole reason we do retirement planning, because it offers the chance to buy stocks at lower prices on average. So think about this. If the market's flat for 25 or 26 years and you're buying a ton of cheap stock prices, I mean, when the market, the market not going up means the price is cheap. So you're buying a ton of them. 25, 26 years worth of consistently putting money in out of your paycheck. And then that giant number of stocks that you own then all goes up by some huge percentage. As the market rallies towards the end of the 30 years, it goes up for 3, 4, 5 years in a row. And you make a killing because you owned so many of them. Or what he's saying is, if you chose the number 1 strategy where you buy and the market goes up for the rest of your life, which I would think, that sounds awesome, right? What if the market went up every year? Yeah, let's buy it, right? What if you chose number 1? That's the worst one. The one that ends up with the lowest amount of money is the one where the market goes up every single year for the rest of your life. And then number 2 is somewhere in between where you have periodic bear markets. Why is this so important? We're not going to get number 3. We're not going to get number 1. The market doesn't go straight up forever. It hasn't ever been flat for 25 years and then gone up, steadily for 5 years. It's the one in the middle, number 2, that we actually get, which is sometimes it's up, sometimes it's down. You guys know I'm not a fan of the stock market. But things like 401ks, when you're putting money into a 401k and they're matching you, which you should do, in my opinion, you should get that as long as it's 100% match or 75% match from your employer. The money kind of needs to be in the market. When there's a bear market, it's actually good for you. When you see your 401k balance go down, that's actually good for you. Because what it means is every paycheck, when you're buying into that market, you're buying shares of stocks or mutual funds or whatever that are on sale. They're cheap. Then when they go up, you own them and you're earning money. Those periodic ups and downs, as long as you have the time, again, I don't think you should be doing it if you're close to retirement. It's just not worth the 33% loss. But the reason I titled this The Bear Necessities is that bear markets are necessary and they are helpful for money that you have to have in the market. Am I suggesting that because of bear markets, you should put money into the market and that that's the best way to save for retirement and the best way to take an income in retirement? 100% no way. On multiple podcasts, I've shown, proven, stood on my soapbox, challenged people to debate me, and no one will. I've got pictures everywhere. I've got Charlie's, watchcharlie.com YouTube channel, Charlie's pictures, all that stuff. Learn from charlie.com to get my books for free. In a million places, I've said annuities and life insurance have earned more than the market anyway, because they don't experience losses. Half of the ups with none of the downs is better than all the ups and all the downs over the last 18 years, period. Nobody can argue that. So no, I'm not saying you should go out and use the market because bear markets are cool. I'm saying for the money you have trapped in the market, because listen, I've done over 1,000, looked at over 1,000 financial plans. My company's growing. There's a bunch of us now. We're seeing more plans than ever. You guys have money trapped in 401ks. If you're under 59 and a half and you're working at a job, you probably can't move that money. You've got a whole bunch of money that we wish we could work with. You wish you could move, but it's trapped in some employer-based plan like a 403b or a 401k or a 457 or something like that. And for that money, I don't want you to be really upset when the market goes down and you lose money in your account. Just keep saving. Keep your contributions going in, because you're buying while things are cheap, and when it goes up, you're going to make more money on those than the ones you bought when it was expensive. Does that make sense? Again, Charlie, it's a one-way broadcast. They can't respond to you. It's 129 episodes in. You still don't know that? I'm a little thick. Anyway, all of this, everything I'm teaching, really, in my opinion, should only be applied to money that you have trapped inside of employer-based plans that you're not allowed to move because you still work there and you're not 59 and a half yet. Once you get to 59 and a half, you can and probably should. I'm not saying that unequivocally without looking at your situation. Don't choke on your fettuccine, compliance guys. I'm telling you, most people who are 59 and a half, if we compare their 401k and the investment options and the fees to the other options, you're probably going to want to move it. And you're allowed to for most companies when you're 59 and a half. So if you're 59 and a half and you have money in or older and you have money inside of a 401k, give us a call, 888-285-2268, 888-285-2268, or you can email charlie@jewett.wealth.com, CHARLIE @Jewett, JEWETT, wealth.com, or you can find me on the internet anywhere. Just put in, Charlie Jewett or Renovating Retirement, and you're going to bump into my stuff, my websites, and find a way to get in touch. But we should be transferring that money out of your 401k in most cases somewhere else that's safer and has lower fees. Now, there's ways to have no fees and no losses. And if you've heard all my podcasts, which several people have listened to every single one, risk isn't necessary anymore. Risk has been unnecessary for like 30 years. And for the last 20 years, not taking risk has been incredibly profitable. Meaning the people that didn't risk their money made more money than the people that did risk their money in the stock market in certain situations. And what do I mean by that? I'm talking about indexed annuities and indexed life insurance that are set up properly, not anything you can buy. I mean, you can go down to your local insurance agent and say, I want an indexed annuity, and they might have one. That one didn't necessarily beat the market, just like You don't hire a, quote, musician for a wedding. You find a great musician, right? Do musicians make good money? No. Most musicians don't make good money, but Taylor Swift does. Panic at the Disco is doing pretty well. Dua Lipa, she's on the rise. Shawn Mendes, nobody ever heard of him until like 2-3 years ago, and now like you got 10 songs on the radio at the same time. There are musicians that make good money, and there are annuities that crush the market. There are life insurance policies that crush the market. They're just rare. It's maybe 2 to 5% of all the annuities that exist that are that good, or 2 to 5% of all the annuities that are all the life insurance policies that exist that are designed properly and work that way. And guess what? Surprise, surprise, surprise. It usually pays the agent less when they pick the right annuity or they design the life insurance policy possible, so they're not very popular. You can't study this stuff on Google. You can't go confirm for yourself what I'm saying. If you go to Google and say, our life insurance policy is good, is our annuity is good, you're going to get all of the naysayers saying, nah, musicians don't make any money. Take a look at it. There's all kinds of starving artists. And yet, there's Taylor Swift and Shawn Mendes. We can show you that. That's fine. That's easy. And we agree. We agree with everything negative said about annuities and life insurance for the most part, unless it comes from the world's worst financial advisor who said, I hate annuities and you should too, because he just lies and says things like, anything that an annuity could do can be done better with another tool in most cases, which is a straight up lie, because other tools don't give you guaranteed income for life, even if you run out of money. Other tools don't give you double income for long-term care benefits and blah, 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 a million other things that just make that guy a liar. You don't have to use the stock market. You can avoid losses. You can avoid bear markets completely by using indexed products, where when the market goes down, you don't lose a penny. You just make zero that year. And then the market goes up, you get some of it. Let's say you get half. But listen, guys, even in that model, bear markets, losing years, are so good. So good. I mean, I kind of hope for them. I wish we could have a down year every other year. 1 year down, 1 year up. 1 year down, 1 year up. Instead of 7 or 8 up years out of every 10 years. Why do I say that? In an index strategy, when the market goes down, you don't lose a penny. Your account stays exactly the same size. But then they reset your measurement. Go back and listen to really early. I think it's like number 3 or number 4. I bet you don't fully get the power of the annual reset yet. When you have that annual reset and you don't make any money for that 1 year measurement, but then they start the next year and they measure at that new low and say, is it up or is it down from there? The probabilities that it's up from there historically are huge, and the probabilities that it's up 20 to 40% the next year are really consistent. I've got the entire history of the S&P 500, and I can show it to you. My team can show it to you. After down years, there's a bounce. So market, let's say back when the market was at 1,000, it went down to whatever, it went down to 700. And then the next year, it went up to, 800 and something, 820, 810 or whatever it is. It doesn't get back to 1,000. It's not a recovery. The people who are in the market didn't make their money back. But you just had a year where from 700 to 810 or whatever, and I don't know what that percentage is, but it's, over 10%. Obviously, you had a banner year where you made a lot of money and probably hit your maximum or made a really good amount of money. So not losing money and making some of the gains, having no fees if possible. Annuities can have no fees whatsoever. Life insurance is going to have fees, but we can lower those to where it's not even really necessarily a fee. It's something you're paying instead of paying taxes. So in every other investment, you'd have to pay taxes. If you made 9% on something, that's your gains, and you had to share either, if it's in an IRA, you have to share your income tax level. If it's outside of an IRA, you have to share a capital gains tax of 15 or 20% with the government, the IRS. 9% goes up. What are you sharing? Like 1, 2, 3%, whatever it is. You just share 1, 2, or 3% with the IRS. Inside of a life insurance policy, your expenses are never going to be 3%, by the way. If it's designed the right way, they're never going to be probably even 2%. They're probably going to be, 0.5% to 1.5% if it's designed properly. Is it a fee? Yeah, kind of. I mean, if your family dies, they're going to pay you millions and millions and millions of dollars. So it's a fee where you're buying something. It's not a management fee like Edward Morgan Lynch is going to charge you for gambling. But at the same time, it's in lieu of paying taxes, because the growth and the income and the distribution of life insurance is completely income tax free. So you can make this low fee or no fee, no losses, no fee or low fee, and they've beaten the market over the last 18 years. In my book, that's a winner-winner chicken dinner. I hope this helps you guys. I think you people are the best.
Renovating. Retirement. With Charlie Jewett.
But that's all, folks.